First, I have to point out that Partners for Production Agriculture, the former Kearns and Associates, is an introducing broker for StoneX, the former FC Stone and Company. And as such, we're required to give you this disclaimer that says that futures and options are risky things. And if you trade any of them on anything I say today and lose money, it's your fault, not mine. So we can go to the next one here. The story in our business lately has been costs, and most of you have witnessed this firsthand. We hope that all of you did all of your locked in all of your grain back in October, November, December, and have everything covered all the way out through next year. But I doubt that many of you did. Let's look at the next slide. If we look at what's going on in these markets, we had a WASDE report that came out today after I sent these slides in. And it didn't change much here from what you see in the column titled USDA 2021 January. The only thing they did was they increased exports by a whole 50 million bushels, which is way short of the pace we're on at the present time. They reduced the output to 1.502 million bushels down opposite the green line. And so that's, we're going to pour some more fire on this market. I don't think anybody believes we're going to stay at 2.6 million bushels exported on corn. If we look into next year, and this thing kind of has legs, folks. Even with 92 million acres planted, and we were at 90 and 90, and we've been talking to others, and we're at 92. And there was a survey by Farm Futures this last week that had corn at 94 and a half. So that would help on the corn side at least. And a 178 yield, we still don't get much help on the carryout down at the bottom of 1.6 billion bushels. So it's going to be a tough year or so here on the corn side. At this point, there's not a lot you can do there. We'll talk about it in just a minute. Let's go to the next one. We can see the scatter here, the stocks to use ratio and the historic relationship of prices as we go up. Notice the vertical distance there between 460 or so, which this 10.5 stocks to use would suggest, and the 515 that we had at the time this was made would probably be higher than that now. And we think the sole driver of that is China. Their imports of U.S. corn have been kind of unprecedented, and there's three drivers. One of them obviously is the rebuilding of their hog herd. We think that is a very slow process. They're getting the sows put in, but that doesn't mean they're going to have their pigs live to market weight. And so we think it's going to be a while before their production starts going up substantially more, probably 2022 or 3. The second one is rebuilding stocks, corn stocks there. China had taken their stocks down to practically zero, and they've been buying corn to rebuild those stocks. That's kind of a strategic issue with them. And the third one, and Brett mentioned it a while ago, and I think this is a huge deal, is their ban on garbage feeding that they announced in the fall. You're taking a huge number of pigs, probably as many pigs as we have in the United States, and switching them from garbage feeding over to the more normal corn and bean meal diets that we're accustomed to here in the United States and Canada. Or something along those lines. And so it's certainly been stimulative for corn demand. Next slide, please. If we look on the soybean sides, the real fireworks, I think, are right here. I mean, if we look at 21-22 and Joe's numbers here, Joe Kearns is who that's referring to, that 52 bushel yield there would be record high. I mean, that isn't some average of the last 5 years. And the 2014 carryout was down to 92 million acres. The change they made today was a slight increase in exports and a slight decrease in ending stocks down to 135 million bushels. In 1992, we got down to 92. If you go through Joe's math here, and we only plant 88 million of soybeans, and by the way, Farm Futures said we're only going to plant 86, then you've got this thing at an untenable level of year-end stocks next year, given where we are this year in starting this year. So it looks like Chinese demand is still insatiable. If you go to the next one, and the stocks to use price thing here gets really scary. I mean, we take it down to 3 or below 3, you're talking $15 beans. And if you're talking $15 beans, you're probably talking $600 bean meal. So this is a situation that is certainly driven costs higher. If we go to the next one, you can see our model for cost now has the average, the best low cost 25% of the producers about $74. That would put the average producers somewhere near 80, probably just right at $80 on cost of production for this entire year. And we haven't sold any hogs that have eaten very much expensive corn yet. You can see the cost of production here in the first couple of months of the year is still relatively low. These would be the highest cost we've seen since 2014, which was the tail end of the impact of the 2012 drought. Now, so what can you do? Well, I think at this point, the best you can do is accept a small disaster and protect yourself from a huge disaster. What if we have a short crop this year? I mean, then you're talking corn in the $7 or $8 range again, and bean meal in the $600 to $800 a ton range. So at this point, you've got a small disaster on your hands. Let's keep it from getting bigger, and you can do that with some option strategies that would put a lid on the cost here, and you can do that. You can structure it correctly and do it for not a lot of cost. And we would certainly advise you talk to your marketing advisors about keep this disaster at the level it is now, or if we have a little sell-off at some point, maybe gain a little bit on it, but prevent a huge disaster, which could still happen here, I'm afraid. Let's go to the next slide. Okay, we're going to talk about demand, and demand has been terrific since May. This has the final export data for December in it, so that number for December is an actual real per capita expenditures number of $17.48, I believe, up 13.5% from a year ago. It brings our year-to-date real per capita expenditures, which is a measure of demand, up almost 3% in spite of what happened in April and May. When this thing started breaking in March last spring, if you'd have told me we would end the year with meat and poultry demand stronger than it was the year before, I would have told you were nuts, because the impact on the economy I thought was going to drag us all down. And it didn't, because people didn't eat in restaurants, but they still had to eat. And we picked up as much or more on the retail side than we lost in the food service. Next slide, please. I'm going to talk just briefly. Brett covered the exports, but again, as part of demand, we have domestic demand, which was very strong. Here's export demands, and this is muscle cuts on a carcass weight basis. So the year-over-year changes aren't exactly the same as what Brett said a while ago. This one adds up to about 26% of output, up 15%. I think probably, obviously, China, Hong Kong is the really remarkable number on there, but the fact that Mexico came back from a huge hole last summer and ended up for the year, positive for the year, is a terrific accomplishment, I think, and the people doing business with Mexico. Next one, please. If we look at the weekly data, can we have the next slide, please? If we look at the weekly data, they're continuing to be strong. Now, you can see China in the bottom right, significantly lower exports there on a weekly basis than a year ago. But remember, Brett talked about that rush of exports to China that happened late in 2019 and into the first third or so of 2020. But the levels that we're shipping to China now are just about the same as we have been really since June of last year, and in fact, better than we were in August and September. They're just kind of holding in. The totals, you can see, are just not very much lower than where we were a year ago, and actually about the same as we were in November and December. The table on the left shows the most recent week, 46,300 new sales, just about, much larger than a year ago, not much larger than the previous week, and 38,300 metric tons of shipments. Again, just hanging in. We think that the export situation is very good, and especially with a weaker dollar, we're going to stay in that. So the bottom line is the two major demands, domestic and exports, still look very good for the pork industry as we go into 2021. Next slide, please. This is cold storage, and this one has been a bit of a head scratcher. I can't figure out how pork in cold storage dropped by a third and stays there and actually has been going down, while the amount of beef and chicken in cold storage is about where it was a year ago. I don't have a good explanation for that. I've called the USDA people that do the cold storage report. They don't really have a good explanation for it either, but they're convinced that their surveys are good. Their response rate has been just about as good as it ever has been. The survey responses make sense to them. They've gone back and checked with individual companies to make sure they're accurate. And yet here we are at just over 400 million pounds of pork in cold storage. That's only about 3 days worth of production. And it looks like the industry is kind of getting comfortable with that. Now, if you think about what has to change here, we either have to run much higher production for a short period of time to rebuild these stocks to 500 or 600 million pounds, or we have to have much lower consumption for a while in order to do that. And I just don't think either one of those are going to happen. Given this year, what we're looking at as far as the level of output, I don't think we're ever going to get ahead far enough to rebuild these stocks significantly. So what does that mean? Is this bullish? I don't think it's bullish necessarily, but I know it isn't bearish because we don't have a big tranche of frozen pork out there ready to be dumped onto the market if the price goes up. There's just not going to be there. So I think it's going to allow what happens in kind of the fresh market, on the day-to-day market, to really drive the boat this year as far as what happens to prices. It's just not going to be a big factor on the negative side. I think any positive impact has already been felt. If you look at those individual cuts, I mean, our stocks of hams are down sharply. Stocks of bellies are down over 50% from a year ago. And so I think we're set up here for, any kind of price rally we see in the spring will not be damaged by product that's in the cold store, in freezers. Next one, please. The Hogs and Pigs report, kind of old news by now, the December Hogs and Pigs report. We're still living with it until we get a March report here in about 4 or 5 weeks. But still, this was kind of bullish, we thought, in the short run because of the market inventories, which were slightly lower than expected, but somewhat bearish in the long run, mainly because of the farrowing intentions. We go to the next one. It showed a breeding herd that was down about 3% from a year ago. Now, we're not real sold on that number because we don't think sow slaughter was quite large enough to get that done. But you can see that, we're down about 200,000 sows from the peak that was set back in December of 2019. Just about, we're kind of approaching our previous high for the breeding herd of 6.2 million back in 2007. We don't think this breeding herd is going to go down very much more because even with the high costs that are out there, lean hog futures right now have us in a profit situation for 2021. So there's not a lot of incentive to go out and be slaughtering sows. We go to the next one, we're going to see sow slaughter. And it's been running above a year ago, but notice it's coming down toward year ago levels. We think we're going to drop back in here in the 65,000 range here for the rest of the spring. And that's going to put us in a position where, the sow herd isn't changing very much. The reason we're really up for the year here, this year to date of 5.2, it's at 5.9, pardon me, is we had a big catch-up week the first week of this year. And if we go to the next one, you'll see sow slaughter as a percent of the breeding herd. And to really get liquidation, you have to be bumping up against this 1.1% number as a percentage of the breeding herd. Remember, we have a much bigger sow herd now, so we should have larger sow slaughter, and you'll have to have a larger, a certain percentage of that breeding herd in order to be reducing it. Now, you can see late in the year, we approached that 1.1% level for a short period of time, and sure enough, USDA says we reduced the sow herd. But to reduce the sow herd by much more than what we already have, we're going to have to maintain this 1.1% level, and we've dropped back from it pretty sharply down to about 1%, and that is no more than a maintenance level of sow slaughter. Let's go to the next one. The key issue for 2021 supply, we think, is productivity. And pigs saved per litter is on the left, and you can see that it flattened in 2020. No question about that. This is 2020 right here. But the reason it flattened was because of management decisions. When the packing plants slowed down last spring, we didn't have a place to go with some wean pigs. There were some destroyed. We were in a tight situation the rest of the year, and there were a lot of farms that only took 10 pigs off of a sow, or didn't take any pig weighing less than 8 pounds, or whatever it took. So there were pigs being removed from this pig crop all the time during 2020, and it resulted in a flat pigs per litter. Well, that hadn't been the case hardly at all in the past. And we think we're going to return to that kind of growth this year, and that will push the pig crop in 2021 actually to new records in the second half of the year. Now, the second half of the year is not something you got to worry about in this year's slaughter, though. Those pigs will be slaughtered in 2022. But this productivity, if anything, we think this is probably mild in this growth of pigs saved per litter that you see in this chart. And that's because genetically, sows were getting better in 2020. We just didn't see it in the pigs that we kept out of them. They're going to get better in 2021. And so if we allow these sows to produce to their genetic potential and save all the pigs we can, we could get 2 years worth of litter size growth in 1 year out of this thing. And so we think we're a little conservative in looking at this pigs per litter of approaching 12 at the end of the year here in 2021. Next slide, please. Hog slaughter, where does that put us? Well, the red smooth line is our forecast for weekly slaughter through the year. We had to make some adjustments. Obviously, you can't compare to last year, either during the spring shutdown period of our packing plants or during the summer catch-up periods. We do not have us having a lot of problems with slaughter capacity out in the fourth quarter. You can see that. We think slaughter is headed for 2.6 million here for quite a while. Pretty quickly, we've run above that here in January and the first week of February, largely because of pigs that got backed up by 2 Friday holidays in December and in December 24th and December 31st. And so those pigs had to be slaughtered. And if we go to the next one, the weights kind of tell you that. Weights jumped the week of Christmas. They stayed high into January, but they've come down very quickly during January. That last observation is February 5th. We're less than a pound above year ago weights. And we think we're going to come back down and start moving toward those year ago weights. And then, of course, move under them, especially when we get out to April. Now, what impact will high costs have? Eventually, it will have an impact. I don't think there's a question about that. When the cost of putting on those last several pounds of gain is high, you discourage those kind of moves, and so you're going to get pigs moved a little earlier. We don't think that'll probably take over until maybe March or April, and at that point we could see a few weeks below year ago. If we go to the next one, the problem with weights is on the packer raised pigs. And it has been, they went up dramatically during the shutdowns. They stayed up in the fall. And this is virtually all driven by North Carolina. We think that the rest of the country was pretty well caught up on their marketings by October. But North Carolina has had trouble. The Tar Heel plant ran below capacity for months, really didn't get back up to it until maybe December. And so, they started gaining a little bit there in December. The holidays set them back. They gained 3 or 4 weeks. Last week was kind of level on this. These weights are going to come down, but they're going to come down pretty slowly. And they're adding about 1% to production. So they do have a market impact that these animals are so heavy. We do know that we have heard that Smithfield will stop shipping hogs from North Carolina to their Illinois plant sometime late February, early March. They will feel like they've gotten caught up enough that they can do the rest of it in North Carolina. So those are good things, but it's amazing that almost a year after this started, we're still dealing with backed up hogs in parts of the country. Next one, please. Where are our slaughter forecasts? You can see ours here in the gray shaded area for this year, virtually unchanged from last year. This number has been plus 0.4% and minus 0.4%. And when I ran it this last week, I've got minus 0.1%, a little smaller than Iowa State or Livestock Marketing Information Center. USDA's number is a production number in billion pounds, not million head, and they're up 1.3. This down 1% would put us up about 0.5% on production. We think weights will end up the year a little heavier than last year. Now that could change too if these high costs persist or get worse. Next slide, please. What does that mean? Well, this is our model based on Iowa State University parameters. And this is the same cost line you saw a while ago, the red and green here, average of 74 and change for what we think is the low cost producers out there. If we put 2021 futures with normal basis levels on this, that would put us at plus $12 or so for that low cost 25%. That would put the average producer at maybe a $2 profit. Now these numbers are $10 better than they were 3 weeks ago because of the rally in lean hog futures. So right now, this is shaping up to not be a bad year. You can lock these in if you have those kind of costs and if you have that kind of basis. There are some folks that don't have those kind of costs. As I said, if you're average, you're probably $10 a head higher. And one of the issues here is basis. If you're selling on a negotiated market, your basis probably isn't as good as what we have reflected in this, which is based on a long-term historical basis. Next slide, please. The cutout value, nice rally here in January. We had forecast the cutout value to lag some in February. We think that that's probably off the table now, and we're probably going to kind of run sideways. We have a peak for the cutout value now at just over $100, but notice when the peak occurs. And the reason it does is because we stopped gleaning those pigs last fall over here in October, November, somewhere in that time period, and we're going to start seeing larger slaughters relative to history as we go out through the second half of the year. Next slide, please. This is our forecast for price, national net price across all purchase methods. If you're on a negotiated price, you're probably going to be $8 to $10 below this. If you're on a cutout value price, you'd probably be something rivaling this price. Here's our forecast quarterly this year. You can see where the futures were as of yesterday, as of Friday. Normally, this price historically has run $3, anywhere from even to $5 over the lean hog index. And that's what these futures prices are representing, is the lean hog index. Anything below and smaller in value than $3 or so means that this is a pricing opportunity. And you can see that 3 of these quarters are well below $3. One of them, of course, is the first quarter, which we're partway through. But we still think there's great pricing opportunities, especially in the third quarter of this year. Now, the caveat on that is, you got a futures market that's running up, and a futures market can go wherever it wants to. At some point, I think that these cash prices will be 78 to 81 in the third quarter. Right now, they're not close to that, and they might get higher. So you need to have a plan in place for pricing hogs. We think producers do, from the second quarter, all the way to the end of the year, at the point when you think the futures market has done about all it can do. And again, there are good strategies available using options that will put a base under your price and then leave at least a portion of the top side open in case this thing does run to $100 plus, as some people have said they thought it would. Next slide, please. This is the chart for the weighted price, and notice we have the peak now just over 90. Again, in that May time period, backing off back down into the 70s. Much better than a year ago, a very much better year from a price standpoint, and it will be from a profit standpoint as well. Next slide. This shows the negotiated price. Notice only $80 here. And so this negotiated market is pretty well shot, guys. If you're on it, you need to make every effort to get off from it with some kind of pricing mechanism tied to the net total, tied to the cutout value. We think that the best cutout pricing mechanism is something on the cutout value. The next slide, please. I think backer margins. And this is one thing you need to consider, though. We've historically had some of those contracts in the 90 to 94, as high as 94, mainly 90 to 92% of the cutout value. Because packer costs have gone up due to PEDV and all the things they had to do there, we doubt that you're going to be able to get those kind of contracts. Anything in the upper 80s, we think, is a fair deal. And so you need to think about that as you're negotiating. You will be in a better position to negotiate contracts later this year than you have been over the last 15, 16 months when all the bargaining power was in the packers' hands. Next one. So risk to the forecast. Well, number one is always a trade disrupting event. When you're exporting 26% of your production, or 27, whichever percentage is right, you're in a real tough spot if you have a foreign animal disease like African swine fever. So that's the number one risk, always is, always has been. Another short crop would certainly be a big hit to us, because we would see costs go even higher. And that's one of the reasons we think you should be looking at accept a small disaster to prevent a big disaster. A negative demand event like swine flu or something like that would certainly be a hit, since we're living on strong demand right now. I don't know of any of those that are coming, but usually those are the kinds of things that blindside it. Normally, I would say the economy in recession would be something that would hurt us, but that had little impact last year. I mean, and it's even more true for beef and chicken. Their demand actually went up more than ours did. So what is driving this? I mean, this is a remarkable thing that we took away all this food service trade that we worked so hard on, and now the retail is carrying us. I think, it could be a very good thing for pork. And the reason is you have a better chance of buying a piece of pork in a grocery store than you do on a restaurant menu. And so if people are more accustomed to that and stick with it, that's probably the big question, is whether they will stick with it. I'm not sure that an extended recession would hurt us. Now, I do think we're going to have kind of a long, slow spell in the economy. We've changed a lot of things that we do. Just this meeting is an example. We're not going to have as much business travel as we used to, because we can do a lot of things with these virtual environments that we work with. Here is the data. Here's the chart from last week's University of Minnesota monitoring project that monitors about 3 million sows, over 3 million sows in 36 or 38 systems around the country, and keeps track of breaks in sow farms on a weekly basis. And this is the cumulative total as a percentage of all incidents back from July 1. They work on a July 1 June 30 year. And you can see that the cumulative total so far this year is the second best ever, tied for the second best ever. Not nearly as bad as we've seen in the past, not much worse than last year. Matter of fact, it's better than last year, but last year's just above it, the purple line here. And so, so the objective data we have says PRRS isn't much worse than it has been in the last several years. The anecdotal evidence is way different. We've had a lot of breaks. I've talked to veterinarians that have dealt with this every year in their career, and one of them told me it might be the worst he's seen in their clientele in 10 years. It's a new variant of the 144 strain. I watched a podcast or a video on the Swine Health Information Center website yesterday. And, I'm an economist, so I understood about every third word of those veterinarians talking, but it didn't sound good, I can tell you that. And so I'm really kind of in a quandary here. If the anecdotal evidence is right, then we should see maybe fewer pigs when we get to the summer. This thing kind of really started in October, so it might start showing up in May. If this chart is right, then we won't see any difference in what we've normally seen, and the forecast that I've shown you here would be right. I would point out one year that has really, kind of concerns me, and that is this orange line, and it's kind of hard to follow, and it comes in just above the 12 here, right at the 12, and it started the year at a pretty good level and ended up the fourth worst yet. Now, that's the only one I can find in there that really kind of gets going as we go through January, February, March, and April. Interestingly, I think that was the year that the 174 variety came, kind of blew up in North Carolina and then spread. I may have the wrong number on that, but it's certainly worth monitoring. But right now, the objective data says that we're not in any worse shape than we ever are on PRRS. And I think that's my last slide.